You go out and you buy this $200,000 property. This $200,000 property is divided up into two parts. $30,000 you paid for the land, and you paid $170,000 for the actual building on the property. But you didn't buy this house to live in yourself. You bought this $200,000 house to rent out to another family. And let's assume, for the purposes of this example, that you could rent out this house for $2,000 a month. That means you could make up to $24,000 a year of income, but you got expenses. You got to pay property taxes on this property. You got to pay insurance costs. You got to pay maintenance fees. You got to pay somebody to manage the property, and you might have some vacancy time to time. So let's assume that you bought this property all cash and you can make $10,000 a year in profit. So you made $24,000 in revenue, $14,000 in expenses, and you're profiting 10 grand. You don't have a mortgage. Just for the purpose of this example, the mortgage doesn't really change anything for the tax example that I'm about to show you. So we're going to keep it very simple. So now when you have this $10,000 of profit, normally you have to go to the IRS and say, hey IRS, I made $10,000, and because I made the $10,000, it qualifies for this ordinary income because your rental income is ordinary income. If you sold the property for a profit, that is your long-term capital gains. But the income is your ordinary tax rates. But this is where the IRS says, hey, because you are investing in real estate, you deserve some tax breaks. The first tax break that you get for investing in real estate is called depreciation. And what it says is because you invested in this property, well, every year you deserve a write-off. This write-off is because this property might have wear and tear. Even if your property is going up in value, you still deserve to take this depreciation write-off. And when you are investing in single-family houses, that write-off is 1/27.5 of the property. Why is it 27.5? Well, that's just what the IRS says. If this was an apartment building, it would be 1/39. The numbers don't really mean anything. That's just what the tax code says. But you take this value right here, the value of the property, which in this case is $170,000, and you divide it by 27.5. Again, I didn't calculate 27.5. That's just what the IRS rule book says. You take $170,000 and you divide it by 27.5, and what it says is that I get to qualify for a little bit more than a $6,000 write-off every year. So I have $10,000 in the bank. That's how much money I profited physically. But I get to tell the IRS I get a $6,100 depreciation write-off. This is called a paper write-off because no money is actually leaving my bank account. It's just on paper that for the next 27.5 years, I'd get to deserve the $6,100 write-off, which means now I have only taxable income of $3,900. This is the money that I pay taxes on, but I can also take this one step further because now I can tell the IRS, hey, I might have some ordinary and necessary expenses to run my real estate business that I need a write-off for. I might need a cell phone to run my rental property business, to communicate with my tenants and my property manager. That could be a write-off. I might need a laptop or a computer to analyze all my real estate finances. That could be a write-off. I might need gas from my truck to go to and from the property to review things. That could be a write-off. I might need a truck to go see my property. That could be a write-off. Those things would then reduce this income down lower, and you only pay taxes based off of what's left. Or if you really want to make it spicy, maybe you'll need to go to Hawaii with your business partner who is your spouse, your husband or your wife. Your husband or your wife is your business partner, and you two need to go to Hawaii and need to go and stay at a nice hotel and eat at some nice restaurants. Those things can be business expenses because if you're going to Hawaii to meet a realtor to look at some property, well, now you're going there with the business mindset to go and look at properties, and those expenses for that business trip are now a write-off. But you gotta make sure you document these things and show how you're going to Hawaii and staying at these hotels for a business expense to look at properties, because if you are, that can definitely be a write-off against your income. Now, I should tell you that making these videos about taxes can be very difficult because this tax code is more than 2,000 pages long, and it's, yes, 8-point font. So there are a lot of nuances with a lot of things. For example, we could have a lot more fun with this depreciation. This 27.5 number that I showed you is just the base depreciation that you can get. If you're a little bit more sophisticated, you could qualify for something called accelerated depreciation, which means you made $10,000 of profit, but you get to depreciate $15,000 in year one. Which means if this depreciation number is $15,000, you have 10 grand in the bank, but you take a $15,000 paper write-off, which means you have a $5,000 loss on taxes. Now, remember what I said earlier, this is a paper write-off. You have a $5,000 loss on taxes, but you have $10,000 in the bank. And you can take that $5,000 loss on your taxes against your W-2 job income, assuming you make under $150,000 a year as a single tax filer or $250,000 a year as a married filed jointly tax filer. So you're making money, but you can take that loss to offset your W-2 income to pay even less money on your job income. And if you say, well, Jaspreet, I make even more than that, yes, there are ways to still qualify for that write-off from your real estate paper loss against your W-2 job income. How? Well, number one, you can qualify as a real estate professional. If you or your spouse qualify as a real estate professional, meaning you spent most of your time working in real estate, well, now that spouse or you can qualify as a real estate professional, and now you can take your real estate loss against your W-2 job income. Or if you're using short-term rentals, things like Airbnbs where people are not staying in your property for more than a few days at a time, that loss that you have from a short-term rental, again, it might not be an actual loss, it might just be a loss on your taxes, a paper loss, but that paper loss from your active rental, your Airbnb, your short-term rental, can be used to offset your active income. That could be your business's income, it could be your W-2 job income, and you don't have the same income requirements, which means, yes, you can make a whole lot more money from your business or your job and offset your job income or your business income from your active rental, your Airbnb rental. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.